So let me just pursue a bit of doom and gloom for you. So everybody's been, we're watching this overheated market, cap rates insane, right? Sub threes all over the country. It used to be just the west side of LA. Now, I mean, really everywhere, right? Seriously, and everywhere, and almost every asset class. It's not just multifamily; it's just compressed everywhere. As you know, obviously, I'm overgeneralizing, but we all know that's the truth, right? Basically. So if at 150 basis points, I think you said 150 basis points or 100 basis points, you see this 46% decline in intent to buy. So the reason for that, if I read between the lines right, is because it's going to cost too much and cap rates are too low. Yep. Right? It doesn't make sense. Therefore, does that not mean that cap rates will start to come up? And if they do, what about all those people that have been buying under the assumption that our cap rate is going to be nicely stable at 3 or 4%? What's the impact going to be on all the people that have bought with those assumptions, you suppose?
Okay, so it is not necessarily true that cap rates will rise. Okay, if you look back over time, we've seen the spread between the 10-year treasury and the average cap rates compress very tight. Back in 07 and 06, now granted, there was a lot of enthusiasm in the marketplace and cap rates were compressed pretty tight, but the spread got very, very thin at that point as well. So it is not a foregone conclusion that cap rates in general will rise. Now, the place where we're most likely to see it is the places where you have a 2.5 cap, a 3 cap, right? The other place you're going to see it is on assets where you have less ability to move rents, things like net lease investments that are tied into a 15-year lease, right? They're going to soften up a little bit because that's a coupon clipper, and just like bond yields, would be coming up, you're going to see that in those bond-like types of commercial real estate. Now, for the investor who went in and bought a great apartment asset in a great market with lots of growth, they bought it at a 2.5 cap, they're not going to have a problem, right? Even though cap rates are going up, that's influencing their exit strategy downstream, right? You never realize that new cap rate until you actually sell it. And so their yields are going to be as they plan, assuming, okay, we're going to raise rents over the course of the next several years, and our cap rate will rise. We may have bought an apartment building in Austin where you have great employment drivers, you're going to have great in-migration, the demand for housing exceeds the supply, and you're going to raise your rents and you're going to grow that revenue. So I already bought it at 2.5 cap. Rising cap rates don't really mean a lot to the performance of that asset until I sell it later. Now, hopefully, if you bought that at a 2.5 cap and you sell it later, hopefully you're going to sell it at a similarly low cap rate. But if you have to exit, right, if you get the end of a fund and per the rules of your fund, you have to sell that asset, and then cap rates are now at for that market maybe a 3.5 or a 4.5. Yeah, you're losing out on that deal.
Yeah, that's not true. You're going from 2.5 to 4.5.
Yeah, but in the meantime,
that's a 50% drop in value, John.
But in the meantime, your rents have gone up. In that kind of a market, you may be seeing rent growth of double-digit rent growth every year along the way. In which case, if you're achieving that, you're going to offset that.
Right. So
not what you want. Right.
Big ifs, right?
As an investor, when you wrote that check and you bought it, you didn't say, "Gosh, you know what? I hope cap rates go up 200 basis points between now and when I sell it." That's not what you're thinking, right? You're thinking, "Hey, I want to sell it later at a comparable cap rate." But the underwriting was based on rent growth and revenue income growth, and then again, particularly syndicators and funds where they have a strict end of life on these funds and a timeline that they have to hit with the sale of that asset, then those guys are gonna they're shaking the dice a little bit.